Okay, learning objective 2.2. Use of chart of accounts to record transaction in T accounts according to the rules of debits and credits. So this is a very, very important PowerPoint slides. Hopefully everyone will take this to heart. There's a lot of memorization and rules that we will use throughout the course. So recording business transactions, debits, and credits. Learn the rules. You have to memorize these rules. And the next slide may be a better place to truly memorize these, but this is a nice table too. We talk about normal balance, which normal balance is the side of the equation where we are increasing an account. So for example, if we are getting cash in the door and we want to increase an asset, we will debit it. If we want to decrease an asset cash, we would credit it. Okay, but liabilities are treated in an opposite manner, because liabilities, if we want to increase a liability, we would debit it. If we want to decrease a liability, we would credit it. Or I'm sorry, I said that backwards. If we want to increase a liability, we will credit it. If we want to decrease a liability, we will debit it. Okay, and you can see all the rules here for revenues. To increase revenues, we credit it. To decrease revenues, we debit it. Expenses, we debit to increase, we credit to decrease. Okay, so the normal balance of the account is in that first column there. So that is the account, the way your rules of debits and credits to increase the account. So the normal balance of an account is the side that increases. Okay, so this next page here, I'm hoping maybe gives you some hints to how to memorize that a little better. But we have our accounting equation, which is assets equals liabilities plus owner's equity. On the left side of the equation, assets, we debit to increase assets. On the other side of the equation, we're crediting to increase. So liabilities and owner's equity, we credit to increase. Now the expanded accounting equation subtracts out withdrawals, adds revenue, and subtracts out expenses. Now you notice withdrawals, which are subtracted, and expenses, which are subtracted, we debit. So we do the opposite of liabilities and owner's equity. We debit it to increase it, and expenses we debit to increase it. So because of the expanded accounting equation, you're subtracting. That's why it's the opposite sign. Revenues we credit to increase. So if you memorize the accounting equation, the expanded accounting equation, one way to think about it is assets on the left side, you debit it to increase the account. Everything else over here, you're crediting to increase the account, except when these are the opposite sign. Then your rules of debits and credits, change to or opposite sign, okay? So down here, your rules for withdrawals and expenses are the opposite of those for capital and revenue. Okay, so, this is I always think this is a really good chart to memorize. Here all we did is move, kind of general algebra, move withdrawal and expenses over to this account. If you remember, these you're all debiting to increase. The ones on the right side, you're crediting to increase. Okay, it's just rules of accounting. You really, no easy way, you just got to memorize, and we will use this every single day in accounting. So important, the sooner you can memorize it, the better. Okay, we also always have to have a balanced equation. So anything you debit, you have to credit the same amount to the other side of the equation. So you can have multiple debits, one credit. You can have multiple credits and one debit. You can have multiple debits and credits. The equation just always, always, always must be equal. Okay, chart of accounts is a number listing of all the business's accounts. Here is an example of Jess Bora's consulting firm chart of accounts. Every single company out there has a different chart of accounts. The numbering scheme could be different. Generally, though, assets are always start off with a 1, liabilities start off with a 2, owner's equities start off with a 3, revenues start off with a 4, and expenses start off with a 5. But like I said, like a huge company could have a chart of accounts. Like I worked for Blue Cross and Blue Shield, a huge insurance company, one of my first jobs, and their chart of accounts was probably 20 pages. This is very simple chart of accounts, but, some companies have 10 cash accounts. Some own maybe trucks or have different assets. So keep in mind that this is, different companies. But for this particular chart of accounts, these are the accounts you will use to do your entries. Okay, transaction analysis. Okay, the 5 steps to analyzing each transaction. So there is always a transaction and different things that you are doing, in accounting. You're analyzing transactions. This 5-step process after time should become second nature, and you should be able to do in your head very quickly. Right now, we're kind of learning just very basic and going over these 5 steps over and over, but hopefully very shortly you can just do these steps right away on your own. So the first step, determine which accounts are affected. So you have a transaction, you're buying or selling something, or you're paying a bill. So a transaction will always affect at least 2 accounts. Okay, so maybe you're paying rent expense. So you would debit rent expense, credit cash. So there's 2 accounts that are always affected. Okay, so first thing, look at the transaction that's happening, determine the 2 accounts that are impacted. Step 2 is determine which category accounts belong. Are they an asset, a liability, capital, withdrawal, revenue, or expense? Step 3, determine the accounts increase or decrease. So if you receive cash, it's an asset, and the rule for assets, you debit it to increase it. So, determine what account, what increases. And then step 4, I probably stepped ahead a little. What are the rules of debits and credits say? And then step 5, what does the T account look like? Place the amounts into accounts either on the left side or the right side, depending on the rules. Okay, the 5-step analysis from another perspective. So again, these are the same steps. It's just, saying, okay, step 1, look at the accounts affected, decide the category. Is there an increase or decrease? The rules of debits and credits, and the appearance of T accounts. So do not try to debit or credit an account until you go through the first 3 steps of the transaction analysis. Okay, so now we're going to apply this. So for the next 10 slides, we'll be learning how to classify each transaction, and we'll go through a lot of transactions. So transaction A, on August 28th, Jess Bora invests $6,000 cash and $200 of computer equipment in the business. Okay, so the accounts affected is cash and computer equipment and Jess Bora capital. We know, or we should know, the cash is an asset, computer equipment is an asset, and Ch2 capital is a capital account. Like I said, you need to know what accounts belong to what category. It's so important. It's got to be something second nature that you're doing. So memorize and learn where, what asset accounts look like, what capital accounts look like, what liability accounts look like. Okay, step 3 is determine, are these accounts increasing or decreasing? So asset, cash, we're investing $6,000 cash. So you're bringing more cash in the business, so that's increasing. You're bringing a piece of computer equipment into the business, so that's increasing. And your capital is also increasing. Okay, but now you have to, step 4, look at the rules of debits and credits. So an asset, to increase an asset, you debit it. To increase computer equipment, an asset, you debit it. To increase capital, you credit it. Okay, so now you go to your appearance in the T account. So you have each one of your accounts and you're debiting cash $6,000. So you're putting it on the left side. You're debiting computer equipment. You put that on the left side. And you are crediting capital. So now you can easily see your debits of $6,000 and $2,000 equal your credits. Your accounting transaction has to be equal, and your debits have to equal your credits. The A signifies that it's transaction A. We're going to go through 10 pages of transactions. So the A just helps grouping and seeing that one transactions in business. It's just a good way to keep track of your transactions. Rather than use transaction A, sometimes you would use the date and say on August 28th, these things occurred. But for the textbook example, it's using the A. So hopefully this is as clear as mud, and as we go through the next couple slides, it'll become clearer to you. Okay, so that was an example of a compound entry because a transaction that involves more than one debit or more than one credit. So example, a debit of $6,000 to cash and a debit of $200 to computer equipment for a credit of $6,200 to Ch2's capital. The name for this is double entry bookkeeping. Okay, so on to transaction B. Computer consulting firm bought computer equipment for $5,000 cash. So computer equipment is an asset, it's increasing, and it's a debit. So we're debiting computer equipment $500. We put that on the left side of the equation into our T account. Cash is an asset. We're paying for that piece of computer equipment, so we're decreasing our cash or decreasing our asset. So we will credit cash $500. So we put that on our right side of our equation of our T account for cash. Oops, didn't mean to do that. Okay, the next slide. Transaction C, bought more computer equipment on account, $300. Well, this is easy if we keep doing the same transaction. The only thing, this one's different because it is on account. Last transaction B, we bought it with cash. So on account means accounts payable is going to be used, which is a liability. Okay, so we're using the accounts affected are computer equipment, accounts payable. Computer equipment is an asset, accounts payable is a liability. We're increasing computer equipment, we're increasing the liability. So to increase an asset, we debit it. To increase a liability, we credit it, because remember, liabilities are on the other side of the accounting equation. So we input into our T account. Transaction C, we're debiting computer equipment, and we're crediting accounts payable. So we put that on the right side of the equation. Transaction D, provided consulting services for cash. So the two accounts affected are cash and consulting fees. Remember, these accounts affected we're getting from our chart of accounts. So in your homework problems, you should be giving a chart of accounts to see what accounts should be affected. Then you look, cash is an asset, consulting fees is a revenue. We're increasing cash, we're increasing revenue. Cash, to increase an asset, we debit it. To increase a revenue account, we credit it. So we update our T accounts accordingly. Transaction E, provided consulting fees on account. So on account is accounts receivable, because now the customers owe us $3,000. They didn't pay us for their services. So the accounts impacted are accounts receivable and consulting fees. Accounts receivable is an asset just like cash, but it's amounts that customers owe us. So consulting fees is a revenue. We're increasing both these accounts. To increase an asset, we debit it. To increase a revenue account, we credit it. So we fill it in appropriately in our T accounts. Transaction F, received $900 cash from clients for services rendered previously on account. So the accounts affected, we're debiting cash. Our cash and accounts receivable, these are both assets. One's increasing, one's decreasing, because their customers are paying on account. So now their accounts receivable is decreasing. So this is called like a shift in assets, where your cash increase and your accounts receivable decrease. So if cash is increasing, we debit it. If accounts receivable is decreasing, we credit it. So, several of our customers did not pay us. They put their consulting fee on account. And now several of the customers are paying that with cash, paying us. So our accounts receivable is being reduced. Okay, transaction G, paid salaries expense. Most important transaction you do, pay your employees, $700. So the accounts affected are salaries expense and cash. Category, it's an expense account and an asset. We're increasing our expense, decreasing our cash. The rules, to increase an expense, we debit it. To decrease cash or an asset, we credit it. And we complete our T accounts appropriately. Okay, transaction 8, rent expense. Paid rent expense. So the two accounts affected are rent expense and cash. The categories an expense and an asset. We're increasing an expense, decreasing cash. The rules, to increase an expense, we debit it. And to decrease cash, we credit it. And we complete our T accounts. Transaction I, received a bill for advertising expense to be paid next month. So it is, again, on account. It's money we owe somebody for advertising expense, so it's an accounts payable. If customers owe us it's an accounts receivable. If we owe a vendor, it's accounts payable. So where the accounts affected are advertising expense, accounts payable. The categories are expense and liability. We're increasing our expense, increasing our liability. So if we increase our expense, we're debiting it. If we're increasing our liability, we're crediting it. So we fill it out appropriately in our T accounts. Transaction J, borrow, withdrew cash for personal use, $100. So if an owner takes out money of the business to pay a telephone bill or just to have petty money for their weekend plans or something like that, is withdrawals. So the accounts impacted are just borrow, withdrawals, and cash. The categories are withdraw and asset. We're increasing the withdrawal account, decreasing the asset account. Withdrawals, we debited to increase it, and assets, we credited to decrease it. And we update our T account accordingly. Okay, slide 19 shows our accounting equation up here at the top. Assets equals liabilities plus owner's equity. And then you pretty much see your expanded accounting equation with your capital minus withdrawals plus revenue minus expenses. So these are all your T accounts, your cash, your asset accounts, your liabilities, your capital, withdrawals, revenues, expenses. So notice, the normal balance of the capital account is a credit, and that's where we have our balance here. The normal balance of a withdrawal account is a debit. So that's where our balance is. So unless there's unusual activity, generally that should be your normal balance of the account. Revenues, the normal balance should be a credit. Expenses, the normal balance is a debit. So all these are debits. Next, what we're going to do is foot the accounts. So we are going to add up all the debits, add up all the credits, and then the debit is bigger than the credit. So we take 8,900 minus 1,700 to get your balance of the cash account, which is 7,200. And again, assets, the normal balance of assets are a debit, which would make sense. Would you have a negative cash balance? Hopefully not. Sometimes, there are situations where companies carry a negative cash, but generally cash should be positive. All your asset accounts should be positive. So you foot your account by adding your debits and your credits and taking the net to find out what these balance of these accounts are. Okay, so anything that had more than one account, you foot it to find out your balance. Consulting fee revenue, you just add up your credits. Okay, so that concludes Learning Objective 2. Good luck with the homework. Study hard. Memorize, memorize, memorize.